Enjoy your meeting.
Good afternoon and welcome. Thank you for joining us for today's discussion on the TILA-RESPA Integrated Disclosure Rule. My name is Mark Schiffman. I am the Executive Director of REBA. REBA is a trade association. It's a 501c6 representing appraisal management companies who strive for excellence and quality. Together, REBA's members represent approximately 70% of the U.S. residential appraisal and valuation volume. Our focus of the trade association is on advocacy, compliance, and a background check program to benefit appraisers as well as REBA members. Today's presentation is going to touch on the TRID rule as it pertains to AMCs and lenders. We're going to examine the rule and the major impacts on lenders, and then we will have Q&A throughout the discussion. Today's discussion is intended to be informative and interactive. All of the phone lines have been muted at the start. We would like you to use the notes function to submit questions. I'll take those questions and provide them to our speakers today. And we'll be able to log those and follow up with all of the today's participants with answers to those questions. So if you see it on the screen, the slide that's currently up, the notes section is to the lower left side. Looks like a little bit of a notebook. You just click on that, enter your question or your comment, and that will come directly to me. It is my pleasure to introduce today's presenters. Paige Fitzgerald is of counsel at Troutman Sanders. She previously served as an Assistant Attorney General in Virginia for approximately 10 years. She's co-leader of Troutman Sanders compliance practice, working on the areas of federal, state, and local regulatory compliance. Her expertise is wide-ranging, representing financial services, including mortgages, automotive, retail, healthcare, and insurance. Beth Buell is the Vice President of Compliance with Clear Capital. She develops strategies for risk mitigation and ensures Clear Capital remains compliant with all regulatory and industry requirements. Beth has been a certified residential appraiser in California since 1989, and prior to joining Clear Capital, Beth owned and operated her own company as an independent real estate appraiser. She's held several positions at Bank of America, Freeman Appraisal Service, Montrose Appraisal Service, and most recently as Vice President of Compliance at ServiceLink Valuation Solutions. Helgi Hukari is Chief Administrative Officer and General Counsel at Clear Capital. He manages the daily administrative matters and legal regulatory affairs for the company. He serves as a strong industry advocate and works closely with Clear Capital's business and operational programs to ensure company compliance. Prior to joining Clear Capital, Helgi spent more than 10 years practicing the law at an international law firm in Palo Alto, California, and working with investment banks on hedge funds in San Francisco and New York. So without further ado, we will turn the microphone over to Paige Fitzgerald to get us started. Paige?
Yes. Well, good afternoon, everyone. I want to thank Mark in particular and REBA members for welcoming me into this presentation and allowing me to participate. So I wanted to start today with providing a brief background of the TRID rule, TILA-RESPA Integrated Disclosure Rule. Of course, everyone on the call, I am sure, is familiar with the rule, but I want to provide a bit of background to help in understanding the purpose of the rule, where it came from, a little history. So as we know, for more than 30 years, federal law has required lenders to provide two different disclosure forms to consumers when they apply for a mortgage. These forms are required shortly before loan closing, and they're based on the requirements under the Truth in Lending Act, commonly known as TILA, and the Real Estate Settlement Procedures Act of 1947, of course commonly referred to as RESPA. Over the years, these two forms have developed essentially on separate tracks, resulting in some overlapping, in some cases, at least particularly per the CFPB, some inconsistent language. And there are concerns about consumers being confused, and also concerns about lenders and settlement agents finding the forms to be burdensome. So enter the Dodd-Frank Wall Street Reform Act and Consumer Protection Act, which commonly referred to as just the Dodd-Frank Act, and that act created the Consumer Financial Protection Bureau, CFPB. So as part of the mandate, the CFPB was tasked with taking the two current forms, the Initial Truth in Lending Disclosure Statement and the RESPA Good Faith Estimate, GFE, and combining these into the new loan estimate form, and then the Final Truth in Lending Disclosure and the RESPA HUD-1 will now be combined into the new closing disclosure. So basically, the TRID rule results in the consolidation of the 4 existing disclosures required under TILA and RESPA for closed-end credit transactions secured by real property into the 2 new forms. So we'll now have under TRID, a loan estimate form that must be delivered or placed in the mail no later than the 3rd business day after receiving the consumer's application, and then a closing disclosure that must be provided to the consumer at least 3 business days prior to loan consummation. So the TRID rule is broad and applies to almost all closed-end consumer credit transactions secured by real property. There are certain specific categories of loans that are excluded from the rule. Specifically, the rule does not apply to home equity lines of credit, HELOCs, reverse mortgages, or mortgages secured by mobile home or dwelling that is not attached to real property. Of course, everyone is here because of the impending effective date of August 1, 2015, and so this effective date requires that the TRID disclosures be provided by a creditor or mortgage broker that receives an application from a consumer for a closed-end credit transaction covered by the rule and secured by real property on or after August 1, 2015. Now, I'm sure we've all heard some rumors, and I know that probably everyone on the line is hopeful of delay. I know my lender clients are certainly hopeful. Most recently, back in March, after a speech made by the Deputy Director of the CFPB to the Consumer Bankers Association, there had been some suggestion, there's a lot of press, that the CFPB could delay the TRID deadline. However, just a couple of weeks ago, Richard Cordray, who is the director of the CFPB, essentially in a speech on May 12th, pretty much absolutely confirmed that, as in his view, the August 1, 2015 implementation date for the TRID rule still stands, and that was made during a speech to the National Association of Realtors at a conference in Washington, D.C. Of course, numerous requests have been made by the industry groups and companies to delay implementation or at least enforcement of TRID, but so far none of those efforts have been have come to any result. So as we stand right now, we're looking at the August 1st, 2015 effective date. So before going into further detail about the integrated disclosure rule, I also wanted to mention the ability to repay and the qualified mortgage standards under TILA's Regulation Z, which also bears on the fees charged by AMCs. So a little bit of background. Regulation Z requires that prior to extending credit for a residential mortgage loan to a consumer, the lender must make a reasonable and good faith determination at or for consummation of a loan that the consumer will have a reasonable ability to repay the loan according to its terms. So the lender is presumed to have made this determination if the mortgage loan meets the criteria of a qualified mortgage. So lenders are very interested in ensuring that their mortgages meet this QM standard because for loans that meet the QM standard, they are accorded particular positive treatment, certain presumptions, and so it's always in the lender's interest to ensure that these QM standards are met. In terms of the defining criteria of a QM is that the transaction's total points and fees do not exceed certain thresholds. So, for example, points and fees may not exceed 3% of the total loan amount, but then there are some higher thresholds for certain loans below $100,000. So real estate-related fees play into, or can play into, this 3% standard. So the real estate fees are under the QM standard are considered to include certain fees such as property appraisal fees, inspection fees used to assess the value or condition of the property if the service is performed prior to consummation, including any fees related to pest infestation or flood hazard determinations. However, these real estate-related fees can be excluded from the points and fees calculation that would play into the 3% cap if certain criteria are met. So the charge, first of all, must be reasonable. The creditor also must receive no direct or indirect compensation in connection with the particular fee or charge, and the fee is not paid to an affiliate of the creditor or lender. So if one of those three conditions is not satisfied, then the lender must include the real estate fee charges in the points and fees that would go into the 3% cap, even if they would be excluded from the finance charge on under TILA. And with that, I'm going to let Helgi address how this particular standard impacts appraiser and AMC fees.
Thanks, Paige. Yeah, I wanted to step back a little bit from looking into the rule and kind of focus a little bit on some of the impacts, especially as it relates to AMCs and appraiser fees. And I know there's probably been a lot of webinars on the TRID rules, and we're going to try to give enough of an overview of how the rules function, and then kind of break off to the side and have a more focused discussion on what some of the impacts are on AMCs and appraisers. So as Paige mentioned, appraisal fees paid to unaffiliated AMCs, or directly to unaffiliated appraisers for that matter, can typically be excluded from a lender's points and fees calculation so long as they're reasonable. So let's assume we're talking about an unaffiliated AMC here. How does a lender figure out whether the appraisal fee is reasonable? And the good news on that point is that the CFPB has provided some pretty helpful guidance on this in the preamble to the rule. And in the preamble, the CFPB states, the fact that a transaction for such services is conducted at arm's length ordinarily should be sufficient to make the charge reasonable. The reasonableness requirement is not intended to invite an inquiry into whether a particular appraiser or title insurance company is imposing excessive charges. And that's in the preamble to the rule, helpful guidance in demonstrating the CFPB's overall intent to give deference to lenders in determining the reasonableness of appraisal fees. One would assume at least that a lender's contracting process to arrive at competitive rates with AMCs or appraisers would typically satisfy requirements of an arm's length transaction. But I think there's some additional factors that lenders can also consider to ensure that the appraisal fee is reasonable and therefore can be excluded from the points and fees calculations. I'm going to turn a little bit just to talk briefly on appraiser fees specifically and then AMC fees. And as it relates to appraisers' fees, there's been a huge amount of regulatory guidance on what makes an appraiser's fee customary and reasonable. And I'm not going to go into a lot of detail on this. I think it could probably fill up a couple webinars on its own. But in the interim final rule on appraisal independence, issued initially by the Fed, there's a lot of detail on how to determine a customary and reasonable appraiser fee. As kind of an aside, there's also been some discussion in the last couple months about whether regulators might be revisiting the interim final rule in the coming year. I think regardless of whether the rule is revised or not, Dodd-Frank requires some form of rule to guide lenders and their agents in determining customary and reasonable appraiser fees. So whether this rule stands as is or is replaced, I think there will be a lot of information to guide lenders here. Really briefly the current interim final rule, there's two alternative presumptions of compliance. The first presumption is a market-based approach. This basically says that an appraiser fee will be customary and reasonable where the amount is reasonably related to the rates paid in the geographic area for comparable assignments. And the rule suggests a 12-month look-back period to determine what a market rate is for those local markets. And then to ensure we're comparing apples to apples and determining the market for a particular appraisal assignment, the presumption requires that the determined market rate be subject to adjustment for factors such as type of property, scope of work, turn time, appraiser qualifications, and experience and work quality. And then finally under Presumption 1, a lender and its agents are allowed to consider fees previously paid by AMCs when they're determining the appropriate rate for the market and the assignment. The second presumption of compliance, again, probably nothing new here for most everyone listening in, is a fee survey. Fee survey has to be prepared by independent third parties, and the fee survey may not consider fees previously paid by AMCs when determining the customary and reasonable rate for an assignment in a given market. So again, a lot of guidance to back up lenders' determination of the reasonableness of appraiser fees. And let's turn now and talk a little bit about AMC fees. And there's not as much regulatory guidance on what makes a reasonable AMC fee. So I think it's something that a lot of people are looking at fresh here. And fortunately, I think there's a lot of analogies that we can make. And in talking about AMC fees, I think much of this analysis applies whether we're talking about a separate AMC plus fee and a cost plus model, or if we're looking at a blended overall rate to the borrower that might include components of both what the appraiser is charging for his or her services and what the AMC is charging for appraisal management services. Also an aside here, I think Paige is going to talk about this a little bit later in the presentation, but currently it's the lender's option whether or not to break out that appraiser fee component and the AMC fee component in the loan estimate. We'll go into that in a little more detail later on. But turning back to the question on AMC fees, when we're considering the reasonableness of the amount charged by an AMC for its appraisal management services, a lender should look to the fair market value of the actual services that AMC is providing. And it brings up kind of an interesting point. Since the range of services offered by AMCs may vary, I think there's a strong argument that AMC fees may likewise vary and still be considered reasonable under the TRID rules, thereby giving the lender some comfort that they're not going to have to include those fees in their points and fees calculations. There's not any real crystal clear guidance on that point, but I think a strong argument can be made there. And again, this is all assuming that the AMC is not affiliated with the lender, as Paige mentioned previously. Right. If the AMC is an affiliated AMC, then those charges are going to have to be included in the points and fees calculations, regardless of whether they're reasonable or not. So I think kind of the final point I wanted to make on, sorry Mark, on that previous slide, was just some potential guideposts for lenders in determining whether AMC fees are reasonable and are come in at a fair market value. I think the first thing a lender might want to look at is the specific value-add services provided by the AMC. So many AMCs provide a different range of services, and I think much like the guidance on customary and reasonable fees for appraisers, fair market value might be highly dependent upon the scope of services that a particular AMC offers. Next, I think a lender could look to the work quality and performance of the AMC. And again, by analogy, I think there's some analogies to be made to the regulatory guidance on CNR rates for appraisers. Here, the CNR rules would allow kind kind of consideration and adjustment for the quality of an appraiser completing assignment, I think you could apply some of the same analysis here with AMC appraisal management services. And the good news here is I think most lenders at this point, because of the third-party oversight rules, have a fairly sophisticated process for judging AMC quality. Final factor that I think lenders can look to for determining fair market rates for appraisal management services is the reliability of the AMC. So, here I'm thinking about things like, does the AMC typically complete assignments on time? Are they able to expand and contract based on the volume needs of the lender? And, again, under the third-party oversight rules, lenders should really already be considering these type of questions in working with the AMC in the first place, and likely would not be working with any AMCs that it determines to be unreliable. So I think, overall there's a fair amount of guidance here for lenders to think about when confirming whether their appraisal management fees and appraisal fees with unaffiliated third parties can be excluded from points and fees calculations. And, again, I think when considering the AMC component of that overall fee, I think it's important for lenders to be thinking about what the fair market value of the services is for that particular AMC and what services it's providing the lender. So, Paige, I'll hand it back to you for the next slide.
Sounds great. Yeah, one point that you made, Helgi, which really stuck out in my mind is the third-party oversight. Is across all the industries on which I work that are where there's CFPB regulation, all I hear about is third-party oversight, third-party oversight. So I think to the extent AMCs are seeing increased levels of oversight by the lenders, it's just starting and may be increasing over the next several years, but especially in terms of these sort of considerations that you're mentioning, Helgi. So,
yeah, and I think the good news is I think that lenders and AMCs are becoming much more aware of each other's processes. So that's definitely a good thing.
Yeah, and I think there would be lots more audits, both ways actually, because AMCs in some ways are, we see the third-party oversight, both the entities that are providing the services and the entities for whom they're contracting with. Their audits going both ways these days, and in previous years I've seen only so much the entity that is the third party, like the AMC being audited, but not the other way around. So it's an interesting time. So back to the loan estimate disclosure. So again, in addition to providing the new integrated disclosures, the TRID rule does include also some new restrictions on certain activities that occur prior to the consumer's receipt of the loan estimate. And so these particular restrictions take effect on August 1, 2015, regardless of when the application has been received by that date. So the restrictions include imposing fees on a consumer before the consumer has received the loan estimate and indicated intent to proceed with the transaction, providing written estimates of the terms or costs specific to the consumer before they receive the loan estimate, without providing a statement informing the consumer that the terms and costs may change. Then also there's a requirement that the submission of documents verifying the information related to consumer's application must be provided before providing the loan estimate. So back to the loan estimate, as I mentioned earlier, for the closed-end credit transactions secured by real property other than the reverse mortgages, the creditor is required to provide the consumer with the good faith estimates of credit costs and transaction terms on the new form called the loan estimate. This new loan form integrates and replaces the existing RESPA GFE, the good faith estimate, and the initial truth in lending statement under TILA for these transactions. The lender is generally required to provide the loan estimate within 3 business days of the receipt of the consumer's loan application. And this can be done both in person and by mail. Importantly, creditors may only use revised or corrected loan estimates when specific requirements are met. So generally, when you provide those loan estimates, you can change them and revise them, but only in some very certain particular circumstances. And record keeping is going to be very important to ensure that any changed loan estimates are properly justified in case there's a challenge either by regulator or perhaps in any sort of litigation context. But creditors generally may not issue revisions to loan estimates because, for instance, they later discover a technical error, a miscalculation, or an underestimation of charges. But the creditors are permitted to issue revised loan estimates, but only in certain situations, which such as when changed circumstances, and we'll go into what a changed circumstance is in the next couple of slides, result in the increased charge. So in those cases when there is a specific changed circumstance, and the CFPB has been good in defining and providing some guidance on what those changed circumstances might be. So we'll turn next, so here is the example of page 1 from the loan estimate disclosure. This is just to provide some further context or discussions. Go through a quick review of this page 1 and page 2 of the loan estimate form. So again, this is page 1, includes some general information, including the loan terms table, and that includes descriptions of the applicable information about the loan, a projected payments table, a cost at closing table, and that's important. That drives the second page information, and then a link for the consumers to obtain more information about loans secured by real property at a website maintained by the CFPB. Of course, the CFPB is providing oversight over all of the disclosures and guidance under TRID. So page 1 of the loan estimate includes the title Loan Estimate and a statement of Save this Loan Estimate to compare with your closing disclosure. And to the extent the CFPB has a host of guidance, not just in the regulations and the official interpretations, but small entity compliance manuals, guides about the forms, exemplars of the forms, just a host of information that is extremely helpful to anyone interested in the TRID rule and the various nuances. And it's it's very friendly and easy to read. It's not as technical as one might think, despite some of the technical requirements of the rule. It's pretty well written, I've found. So page 2 of the loan estimate disclosure. So there are 4 main categories of charges that are disclosed on page 2 of the loan estimate. There's a good faith itemization of the loan costs and the other costs associated with the loan in accordance with section 102637. There's a calculating cash to close table to show the consumer how the amount of cash needed at closing has been calculated. And again, this is consumer, very much a consumer-driven requirement, 102637, and subparagraph H. And then for transactions with adjustable monthly payments, there's an adjustable payment table with relevant information about how the monthly payments may change, and that's required by section 102637, subparagraph I. And then again, also for transactions with adjustable interest rates, there's an adjustable interest rate table with relevant information about how the interest rate will change. So the items associated with a mortgage are broken down to 2 general types. There's the loan costs and the other costs. And so the loan cost is where any sort of appraisal type fee disclosure occurs. Loan costs are considered as those costs that are paid by the consumer to the creditor, to the lender, and also to third-party providers, which again, appraisal companies of services the creditor requires to be obtained by the consumer during the origination of the loan. So this is where the appraisal fee disclosure occurs. AMC fee disclosure is optional and has not generally and historically been itemized on the loan estimate in the GFEs. But under the new loan estimates, they can be disclosed separately, or they can be disclosed as part of a general appraisal fee. So the other costs would include, and again, this is not relevant to the appraisal fees, but the other costs that are disclosed include taxes, governmental recording fees, and certain other payments involved in the real estate closing process. So I'm going to turn to Helgi in terms of the sort of the zero tolerance threshold that's applicable to making changes in the loan estimate, and how changes can be made in certain circumstances, but they're very limited.
Yeah, thanks, Paige. And I think this is also a good opportunity to kind of spend some time talking about how some of these rules impact AMCs and appraisal fees also a little bit more particularly. So as Paige mentioned, some of the fees included in the loan estimate are subject to a zero tolerance threshold. And what this basically means is that lenders aren't permitted to charge consumers more than the amount that's disclosed on the loan estimate unless they meet the requirements of an exception such as the changed circumstances exception. And the zero tolerance threshold, so what kind of fees are included in that zero tolerance threshold, it would apply to fees paid to unaffiliated third parties of the lender if the lender does not permit the borrower to shop for the third party service. So appraisals typically would fall into this category. And what that means is that unless an exception applies, any amounts over the zero tolerance charge that's indicated in the initial loan estimate would have to be refunded to the borrower in the absence of any exception. And that refund has to occur within 60 days after consummation of the loan transaction. So it becomes really important to figure out, how does this change circumstance exception apply, especially if we're talking about appraisal fees. Because as we're all aware, in the case of appraisal fees, there are a lot of instances where the appraisal fee that's ultimately charged by the appraiser might vary from the estimate a lender makes in the initial loan estimate based on an assumption of a typical standard assignment. And things like increased scope of work, compressed timelines, a lot of these factors that kind of insert themselves in the real world can cause problems with having that initial loan estimate ultimately be accurate. And so, I think we can spend a little bit of time on talking about how does a lender determine if the initial loan estimate can be revised and thereby have the increased cost of, in this case, an appraisal service be passed on to the borrower. And that's where this changed circumstance exception comes into play. So under the changed circumstance exception, a lender is permitted to provide a revised loan estimate to a borrower with a higher appraisal fee than what was initially disclosed in the initial loan estimate if the fee will be higher because of a changed circumstance. And under the TRID rule, a changed circumstance includes the following categories. The first is an extraordinary event beyond the control of any interested party or other unexpected event specific to the lender or transaction. Secondly, information specific to the borrower or transaction that the lender relied upon when providing the loan estimate that was inaccurate or changed after the disclosure was provided. And then finally, and I think most relevantly for our circumstances, new information specific to the borrower or transaction that the lender did not rely on when providing the loan estimate. So again, this last category I think is the one that's most likely going to be applicable when we're talking about appraisal fees. And as an example, say the lender estimates appraisal fee in the loan estimate, assuming a typical assignment for a local market. But once the appraiser arrives at the property, he or she realizes there's a lot of unique aspects. Property that they weren't aware of, either kind of when they were giving their initial quote or that the lender was expecting when it put its expected fee into the loan estimate. And assume these unique aspects warrant a fee increase. Maybe the house has been extensively remodeled and enlarged. It's overbuilt for the area. It's hard for the appraiser to find appropriate comps. So the appraiser comes back and asks for an increase. The assignment's now going to be more complicated. Where does that leave us? Is that a changed circumstance such that the lender could revise the loan estimate, send that to the borrower, and then thereby have the borrower absorb that increased fee? Again, here there's some pretty good guidance in the official interpretation to the TILA-RESPA rules on how changed circumstances work. And in fact, they give a specific example on appraisal fees in the official interpretation. I'm going to paraphrase slightly here, but the relevant section of the interpretation basically reads as follows. Assume a creditor provides a $200 estimated appraisal fee, which will be paid to an appraiser and therefore may not increase under the zero tolerance rule. The estimate was based on information provided by the consumer at application, which included information indicating that the subject property was a single-family dwelling. Upon arrival at the subject property, the appraiser discovers that the property is actually a single-family dwelling located on a farm. A different schedule of appraisal fees applies to residences located on farms. A changed circumstance has occurred, i.e., information provided by the consumer is found to be inaccurate after the loan estimate was provided, which caused an increase in the cost of the appraisal. Therefore, if the creditor issues a revised loan estimate with the corrected appraisal fee, the actual appraisal fee of $400 paid at the real estate closing by the consumer will be compared to the revised appraisal fee of $400 in the revised loan estimate to determine if the actual fee has increased above the estimated fee. So in that case, there would be no increase because 400 would compare to 400, you'd be good. The interpretation goes on to state, however, if the creditor failed to provide a revised loan estimate, then the actual appraisal fee of $400, the fee paid by the borrower on consummation, must be compared to the originally disclosed estimated appraisal fee of $200 in the original loan estimate. So in that case, there would be a difference of $200 that the lender could not pass on to the borrower, and if the borrower paid it, they'd have to refund that difference back to the borrower. So, kind of a somewhat long example, but it does help give some guidance on when a lender would be able to pass along the increased appraisal cost to the borrower due to a changed circumstance. And I think, as this example points out, the lender in this circumstance can pass that cost on to the borrower, but they have to issue a revised loan estimate with the new appraisal fee included in that. The other piece that's kind of interesting, I think, something that AMCs will need to work with lenders on in the coming 2 months to implementation of this rule is how do you keep appropriate records? So when a lender's relying on a changed circumstance to justify an increased cost, and in this case, let's assume it's an appraisal cost, what do they need to do to make sure they have an appropriate file to support that decision? And under the TRID record retention rule, it's pretty clear that lenders have to retain records demonstrating compliance with the changed circumstance exception. And so, there's not definitive guidance in the rule on what that record should look like, but I listed a couple of categories here that I think at least give some guidance on some of the areas that that AMCs could work with lenders on making sure there's the appropriate justification and backup and support in the file. First category would be retaining a copy of the information that's provided by the borrower that the lender relied on when providing the initial estimate of the appraisal fee and the loan estimate. And one example, lenders could even develop their own template to collect specific property information from the borrower at the time of application. I think Beth's going to go into that a little bit later in the presentation as well. A second category of records that lenders should consider is a record of the new information that the appraiser claims will increase the cost of the assignment and therefore result in a higher appraisal fee. And that's something where I think, if the lender's working through an AMC, it's going to be very important that the AMC is coordinating this process with the lender and providing the information necessary for the lender's files. A third category would be a record describing how this newly discovered information was not relied upon by the lender when preparing the loan estimate. And then I think the final category of record retention lenders should consider would be, obviously, for this as well as for other reasons, a copy of the revised loan estimate that was actually provided to the borrower that shows the increased appraisal fee amount. So hopefully that's helpful. Paige, I think you were going to spend some time going through the timing requirements for issuing these loan estimates.
Exactly. So if there are revisions, there needs to be provided to the a consumer a revised loan estimate. There's a sort of a general rule that excuse me, that the lender must deliver or place in the mail the revised loan estimate to the consumer no later than 3 business days after receiving information sufficient to establish one of the allowable reasons for the revision has actually occurred, as Helgi has discussed. So again, in terms of the 3, there's also a 3 business day mailing requirement, and if there's evidence that the consumer has received it before the 3 business days, that can come into play, that there's actual receipt. And revisions are permitted for changed circumstances, as mentioned, in some very specific circumstances and instances. Lenders cannot revise the loan estimate once the closing disclosure, and that's the second piece of the second disclosure that occurs right before consummation, has been provided to the consumer. Consumer must be provided with the revised loan estimate no later than 4 business days prior to consummation of the loan. So if a revised loan estimate has been timely provided in accordance with these requirements, then the closing disclosure should reflect any revised changes due to the changed circumstances. So if the changed circumstance, however, occurs too close to the loan consummation to provide the revised loan estimate, in other words, there are less than 4 business days in between the time the revised loan estimate would have been required, then the lenders may provide the consumer with a closing disclosure reflecting the revised changes, again, due to the changed circumstance. Again, as long as it meets the criteria that Helgi discussed. So these new figures on the closing disclosure, rather than the amounts on the loan estimate, may, if the requirements as to timing are met, then in that case they may be used for determining the good faith and the applicable tolerances in terms of whether any refund to the consumer must be made due to a change. So in terms of compliance and certain tools for compliance, Beth is our expert on this, and she's going to go through several tools, including a QM chart and some disclosure timing charts and some other useful information that can be helpful in complying with the TRIG rule.
Yes, thank you, Paige. We were trying to determine what might be helpful for both AMCs or their clients in navigating through the disclosure process as it relates to valuation. And some of the things we come up with were these tools for compliance, and they're all tied to the guidance that's directed and given by the CFPB. And like Paige stated earlier, if you have not done so, you really should go to the CFPB website because they have some really good guidance documents on their site. They're a little bit, they're easy to read, but there's a lot of them, and they're 96 pages, 60 pages, and but there is a great variety. So I would encourage you to do that. And the tools for compliance that we're developing here will probably be ready next week. But the first one is a QM chart, which essentially just, the qualified mortgage has specific caps. For example, if the loan amount is greater than $100,000, the cap on fees is 3%, just a flat 3%. But then the next level is if the loan amount is less than $100,000 but more than $60,000, it's a flat $3,000 fee. So there's some variances in the actual caps. And so we put it in chart form just so that it's easier to read and more at a glance. And so that's one of our tools. The second is a disclosure timing chart. And the disclosure timing is very interesting and it's extremely complicated. And it's all predicated on the application completion and when it was received. And the guidance talks about the application is considered received when the consumer provides the following information. First, and there's 6 elements, and listen to these. There's the consumer's name, the consumer's income, the consumer's social security number, the address of the property, the estimate of the value of the property, and the mortgage loan amount sought. So those are some really, those are very elemental factors, and so once the lender receives those 6 elements, the application is considered to be received and your 3-day countdown starts. So the disclosure timing chart is really important in determining what your timing is and what days you need to be paying attention to. So again, there's a sample on the CFP website, but it's a little bit challenging to read and it's in calendar form, so we tried to simplify it a little bit. The third item is a template for property characteristics information that we can collect from the borrower. And this particular piece is a good tool for record retention. In other words, if you're going to rely on information provided by the consumer, then you need a record of what he provided you. And so we thought it might be helpful if you had a document that was basic and of course can be tailored to your particular needs as your clients or AMCs. For public relations purposes, I'm sure the clients don't want to go back to the borrowers and say, now you have to pay more money. So perhaps this template will help in that, in making sure all the information, all the pertinent information is collected at the onset. And then the last tool we were looking at is a chart or a pictorial of the changed circumstances scenarios. It's a little convoluted. So we're trying to simplify it by a pictorial that will better explain. A lot of us are visual learners, and so perhaps the pictorial will help better see at a glance what the changed circumstances are. So those are the tools that we're looking at. And again, if anybody's interested, just let Mark know, and we'll have those available by next week.
Thank you, Beth. So as we look to the future, the big question for AMCs and for lenders is what's on the horizon. And there are a lot of unanswered questions both for lenders as well as for AMCs, along with a wide array of variability in how companies might choose to handle that. So I wanted to open the floor up to Paige, Helgi, and Beth just to touch base on what's on the horizon and what are some of the critical questions that should be asked at the current time.
Thanks, Mark. This is Helgi. And Beth, thanks for going through those things too. Mark, I assume you can help organize all those compliance tools and making them available to REVA members or any of our guests that might have dialed in on this call?
Absolutely.
Okay, cool. Great. Yeah, so, looking down the road on how lenders and AMCs are reacting and will react on effectiveness of these new requirements. And I think in some respects there's probably about as many open questions as there are answers at the moment. And I know a lot of people are working feverishly right now on coming up with revised processes and procedures. And it's clearly an area where AMCs and lenders can collaborate. And I think as we move down this path, REVA hopefully can play a key role in making sure that there's collaboration between lenders and AMCs, promoting industry awareness on some of these points. But I thought maybe what I would do is, and Beth and Paige, feel free to jump in as well. But I had kind of just jotted down some of the open questions or areas where I think people are focused right now. I'm sure there's plenty of other ones, and I'm not really going to lay these out to provide answers. I wish I had all the answers, but I think in a lot of cases the answers aren't going to be one size fits all. There's going to be a lot of coordinating between a lender's individual unique processes and the AMCs or appraisers that the lender works with. So at least to just kind of highlight some of the things I think we should all be thinking about, I'll go through 3 or 4 of them right now. The first, is like the zero tolerance thresholds. So how are lenders and AMCs going to adapt to the possibility of increased appraisal fees after the initial loan estimate's made? And I think there's 3 basic approaches that could be taken, and probably a multitude of nuances in between these or different approaches altogether. One and kind of the most likely approach that's laid out in the rule, at least, is that the lender revises the loan estimate when there's changed circumstances, and thereby passes on a revised loan estimate and an increased fee to the borrower. As we talked about before, it's going to require much stricter record keeping of property characteristics that are provided by the borrower on the front end, and I think there's going to need to be a lot more coordination with the AMC on making sure that the reason for the adjustment is well documented and supported. So lenders and AMCs are going to have to work closely in that area. An alternative approach could be, that the lender in some or all cases decides not to revise the loan estimate and thereby absorbs that increased cost. That, in turn would likely have a lot of impact on just the relationship between AMCs and lenders on the de-escalation process. So, what adjustments would need to happen there? And I think, kind of the third option would be that at the loan estimate time, the lender puts a cap on any ability to increase that appraisal fee from what's in the loan estimate. And I think, there's a lot of questions that come up in that type of approach. First and foremost probably is, what kind of relationship is currently in place between the lender and the AMC. What does the contract say on pricing? What's the pricing model? Does that need to be adjusted? And I think you also need to look pretty carefully at how that's structured to make sure that, we're not putting something in place that doesn't allow an appraiser to increase their fee based on property characteristics, which is a requirement under the CNR rules. So a couple of things to juggle around there. I think another question that comes up is, what happens if the lender works with multiple AMCs and the AMCs have different pricing models? At the time of the loan estimate, a lender might not know which AMC is going to get the assignment. And if that's the case, what do they put in the loan estimate? Do they use the lowest expected cost? So if they have 4 AMCs, do they use the lowest cost that they think that would occur with any of those AMCs that are used? And again, if so, what impact does that have on the fees paid to the actual appraisers on the assignments? Is there any risk with CNR? You have these kind of competing regulations that are all required to be complied with. Alternative approach, would be, could the lender use the higher estimate, so the higher estimate of the 4 AMCs on what they put in the loan estimate? If so, is there any redisclosure requirement under the TRID rules if the ultimate fee charged to the borrower comes in below what was in that estimate? On that point, at least, there is some guidance in the TRID rules, and it's fairly clear that if amounts decrease from what's in the original loan estimate, the original loan estimate is still deemed to be a good faith estimate for purposes of the QM rule, and therefore redisclosure would not be required. So that could be one approach there. Another question would be, how does a lender actually judge whether a fee increase, when it comes to appraisal fees, whether the fee increase really is a changed circumstance under the rule and justifies a revised loan estimate? I think there's, as we all know, in the real world, there's a lot of different facts and circumstances that get involved in this process. And along that spectrum, when does a lender get comfortable that something truly is a changed circumstance and the increased fee can be included in a revised loan estimate, versus when a changed circumstance hasn't occurred? And by way of example, I think there's a lot of unknown property characteristics at the time of the loan estimate that might increase the complexity of the assignment. And previously talked a little bit about the example of going out and finding a house has been remodeled and enlarged. Those type of things likely would qualify as a changed circumstance. assuming that you're able to show that that information wasn't available to the lender at the time of the loan estimate. So the borrower didn't provide the information, public records perhaps didn't reflect the information. Those type of cases seem, fairly straight within the example provided in the actual rule. But if you go out further on this spectrum and start thinking about what happens if a appraiser goes out and tells you that the CNR rates in that local market are increasing really rapidly. So maybe the lender relied on a just kind of standard assumption on what CNR rates were in that local market when they gave the loan estimate. They go out to try to find an appraiser and find out that CNR has increased. Well, that's, I think, a tougher one. It's not specifically tied to any change in the actual property characteristic or the actual lending transaction. So you might have a tougher time saying that's a changed circumstance. I think all questions that AMCs and lenders need to be working on together. For kind of a final area with some questions, as I see it, and again, there's probably plenty more, but is what impact does the TILA-RESPA rules have on cost-plus models particularly? So, if an appraiser is trying to decide on the front end at the time of the loan estimate what the actual appraiser cost is going to be before they engage that appraiser, does this kind of necessitate that they're using fee schedules or agreed upon rate sheets to be able to know ahead of time at the time of the loan estimate what that appraiser fee is actually going to be? And again, if you're using multiple AMCs in a cost-plus model and you're not sure at the time of the loan estimate what AMC you're going to use, which of the AMC's plus fees would factor its way into the loan estimate. So